The reporting season is in full swing, and so far the results from the big name companies have been a surprise to the upside. Joining me in the studio with his expert analysis on the numbers is Martin Lakos from Macquarie Private Wealth. Martin, earnings season, is it all over?
Well, it's nearly all over.
Nearly all over.
Yeah, we've got
it's a pretty big week, isn't it?
Yeah, look, we've got another 58 or 60 odd companies to go. So we're about 60% of the way through of total number of companies, but well and truly larger than that in terms of total market cap. Don't forget, we've already had the big companies like Rio, BHP, Telstra, CommBank have already reported.
Yep.
Wesfarmers. Look, it is an interesting reporting season, and what we have to look at it is, what was the market expecting before the season?
Yeah.
And so are we meeting or not those expectations, apart from looking at the hard numbers? So from an expectations perspective, where analysts were before the reporting season, we're pretty much in line, if not slightly better than.
So what was the number that we were expecting? Was it up 3% or something?
Actually, -2.5%.
Oh, really? A negative result
across the whole market.
Yeah.
If you took resources out of those numbers, it would be +5%.
Okay.
So that's the impact of basically
mining services are copping a
mining services, and of course, you know, at the end of the day, we have seen downgrades going through from last year in both BHP and Rio in terms of the results. Although we think the outlook is better. Yeah. So given that, that's not a bad outcome, given really tough business conditions over the last 6 to 12 months.
And a pretty slowing economy.
Yeah, absolutely.
Yeah. And so we haven't got the benefits of low interest rates and low dollar coming through these companies yet.
Well, exactly right. I mean, a lot of people are talking about the benefits of the low Aussie dollar, but let's face it, the companies have only really got about a month's worth of that benefit leading up to the 30th of June.
Yeah.
This next 12 months, clearly, they'll get some pretty good benefit of both. In breaking up that reporting season, a few interesting trends. Top line growth, so in other words, the broad revenue number, which is very reflective of activity in the economy, as you understand, pretty flat. In fact, the worst since December 2010's reporting season. Okay. December 2010.
So for people at home, what you're saying is the revenue results not flash.
Not good.
But this is a slowing economy, and it was a high dollar, interest rates were coming down, but the confidence is terrible for both business and consumer.
Exactly.
Still not bad?
And it's reflective of that.
Okay.
The good news on the revenue side is that we think 2014-15 will start to see a pickup. Yeah. So that's going to start to broaden out. On margins, and this is interesting, margins are actually starting to improve. So for the industrials have gone from about 13.5% to 15% on average. The resource sector has even said a modest improvement in margins from about 27%.
So basically the return on the invested capital is looking a lot better.
Just starting to pick up, Pete. Okay. And so if we get a pickup in the economy, we're going to get the bigger revenue, the top line growth starting to kick in. Yeah. Ongoing cost out programs with margins continuing to expand. So profitability will start to, or continue to pick up. And that's
Which
why
should drive share prices, shouldn't it, if profitability picks up?
Absolutely. That's the key driver. Yeah. If we see earnings growth coming through, the share market will go higher. We talked a lot on this program, Pete, from time to time about the revision ratio. Yeah. That's the thing that's a little disappointing from this. We're not seeing...
Define for people who haven't come across this before, what the revision ratio is.
So we look at all analysts across the market, not just our own, but include our own, in terms of whether they're upgrading or downgrading companies. Yeah. And we look at the net result. So how many upgrades versus how many downgrades.
Right. So now, we'd love to hear upgrades are really blossoming and blooming. We'd love to hear that. Yeah.
But the reality is that's not what's been happening.
That's the disappointing part.
Over the last couple of years, we've seen more downgrades than upgrades, and hence that revision ratio has been about 0.5. What we want to see is 1 or more, because it means there'll be more upgrades than downgrades. Yeah. Does that make sense?
Yeah, so if it's 1.5, you're in good territory. Under 1,
correct. Under 1's not so great at all. Okay. So we're hovering around 0.7, 0.8. Okay. Not quite there yet. We think, you know, potentially we might see some more upgrades heading into the new financial year.
Is every company treated equally, or is the figure biased by the capital? Like, for example, if a whole lot of crummy little companies like mining services companies and junior miners are being revised down, that's of less consequence, really, than if BHP and Rio and CommBank and all them have been
You've got to be including the weightings, and particularly from a sector-by-sector basis, because quite clearly the bank sector, which is the largest in the ASX 200, you know, it's 28% of the total market, clearly has a bigger weighting than the small caps or mid caps. So you've got to look at it on that basis as well.
So that revision number is weighted as well.
Correct. Okay. Yeah, absolutely.
So it does really give you a fair indication of now how successful are the analysts do the analysts sometimes get it wrong? Particularly at a turning point. I feel as though we're in a turning point in the economy.
Yeah.
I think that confidence starts spiking once the election's out of the way, and 2014 is going to be better than 2013. That's my feeling, even though some Treasury and Reserve Bank economists think the opposite, but they've been wrong for so long. I'm glad I'm the opposite to them. So if that's the case, is it a harder time to believe in the analysts' revisions?
No, I think it's, for the first time in a while, it's quite interesting because typically at the beginning of financial years, analysts start looking at earnings, and they have typically over the last 3 or 4 reporting seasons been too positive at the early stages of a reporting period. And ultimately they've had to downgrade. Hence that revision ratio has been down. So we're starting to see that turn up. Analysts are getting a little more positive, but they're still being quite cautious. We like the look of it because it does look like they're being quite conservative now. And on our analysis, if we're right on expanding margins and improving top-line growth, we think analysts actually will be forced to upgrade heading in towards the end of the next reporting season.
That's the kind of answer I wanted to hear, Martin.
I thought it was.
Not that
so I said the right thing.
Yeah, not that I am, as some people have accused me of being an eternal bull. I'm not.
Surely not.
But I feel as though I am a bull, and what I'm seeing. But I always like to be confirmed by other people. And if in the end I get 20 people saying I'm wrong, well, I'll change my view.
Yeah, you'll take that on board.
Yeah. So, what has this done to your outlook for stocks and the portfolios you might be creating? What's the impact of this earnings season on those?
Okay, so we haven't officially changed our portfolios yet. We'll wait for the reporting season. But the commentary coming out certainly is that and this has been a theme we've been running with anyway, is we've been looking towards the industrial cyclical stocks. Before we had big weightings towards international stocks, the Amcors, the Ansels, the CSLs of this world.
Yeah, which did well.
Yep. Underweight the materials, but overweight BHP, if that makes some sense. Certainly probably neutral to underweight the banks because we're concerned about the headwinds. The cost out programs had to come through. Lending growth had been quite soft. We started shifting with a focus a little bit more to those cyclicals. So we added in Dulux and JB Hi-Fi some months ago. They've been good performers. It wouldn't surprise me, but I have no inside information on this, that we'll add more stocks into that expanding industrial cyclical base. So what we're saying is if these numbers are right, we think earnings growth is starting to recover domestically, then we've got to have more domestic exposure. So domestic cyclicals, what does that include? Transports, retail, well, that's already run pretty hard, quite obviously. Building materials potentially might be worth having a look at. And that'll even be despite the fact that some of the results in building materials have actually been pretty ordinary. You know, Boral did unfortunately disappoint.
Yeah, well, what was your view on Boral? Boral is the sort of company you think when the housing sector's turning, it should be a beneficiary of it, and also in America, it's turning as well. So what's going wrong with Boral? Do we know? Yeah,
it's a company in transition, and very much a focus on that transition. So we're going to continue to see asset sales. They did quite a good job getting their debt down, which is good news. There's more to go, but it does look like Michael Caine. It's not Michael Caine.
No.
The CEO is Caine. I'm sorry, I've forgotten his first name. K-A-N-E. Is doing a good job on the debt side, starting to reduce costs, but they've got a long way to go because the business really needs to be restructured.
Okay, you mentioned transports. What's the transport company you guys like most of all?
We've got Toll in the portfolio. It's been there for a while, close to 552. Despite what appeared to be an ordinary result, in as much that we didn't see a lot of evidence of the cost out program coming through. We did in there one of the so-called competitors, Asiano. It wouldn't surprise us that Toll will be instigating more cost out programs over the next 12 months. So I think at this stage we're pretty happy with Toll.
It's the kind of company that will benefit from a stronger growing economy, won't it? Particularly with a lower dollar where there's maybe less purchases from overseas. Though I guess they're beneficiaries of even stuff that gets delivered to Australia has to get
Well, they're
to the
beneficiaries of all that. I mean, their express freight business will start to pick up on domestic demand without a doubt. They've got their overseas businesses, which will not only see a pickup because of the Aussie dollar, which is obviously going to be a nice translation effect for them. But you know, activity offshore is not too bad for them at the moment.
Martin, material stocks. Are you guys still warm and cuddly to these sorts of companies?
Yeah, very much so. I mean, look, nice result.
Tell us why.
Okay, so it's not a commodity story. It's very much the thematic that's been running, which is the cost out story. Clearly,
make themselves lower cost producers.
Lower cost producers. Let's look at some of those stats. In the last 4 or 5 years through the mining investment boom, the Aussie dollar was up 15 or 20%. That's a headwind. operating costs, in other words, their ability or the cost to set up infrastructure and services in the Pilbara so they can expand the mines, were up 60% in that time frame.
So expensive labour in that capital building phase, which is now over, and they're in the selling phase, and so those sort of costs have been brought out. The dollar costs have been brought out.
Starting to reduce.
Yeah.
All those associated with that, and the capex side as well. What we're now seeing is they've already invested in those businesses. They now have the ability to deliver higher volume. So although they get lower commodity prices, and the iron ore price we should talk about a little bit, which is holding up quite well, but they will have the ability to deliver more volume. So that actually means potentially an expansion of margins for them. And so we're quite positive BHP.
But have you guys totally ruled out the commodity prices might actually improve? Because we have seen China's done better than expected. Europe has done better than expected.
Not getting any worse.
Yeah, Japan has done better than expected. America, well, we're waiting for them to actually come through, but if tapering starts, their supposition is the US economy is going to improve.
But we've never been really a big bear on the commodity price complex. Yeah. We've been, I think, quite sensible in our forecast going forward. So, you know, $110 a tonne in iron ore. It's currently 138, which is probably high, seasonally high. Yeah. So a longer or medium-term average in that area. Yeah. Certainly, thermal coal we've been more concerned about. We've cut that quite heavily. Yeah. Coking coal in line with iron ore and steel demand still looks quite good. And of course, you've mentioned the magic country, China. Things look like they've bottomed there. Yeah. So maybe we'll see some upgrades, but we're not upgrading at the moment.
Quickly running out of time, Fortescue. I noticed that Charlie during the week says it's a much better company than years ago. Do you guys like Fortescue?
Peter, I'd love to be able to comment on it, but I'm not able to.
Okay.
Sorry.
I know sometimes there are the cone of silence over Macquarie.
Yeah, this is one that there is.
But you could actually develop like a wink. Where I can actually say, I know you can't talk about it, Marty.
I have no twitches, none whatsoever. Sorry, I can't help it.
Twitching is out. Is it? Martin, thanks for joining us.
Thanks, Ben.